Alright guys, so welcome back to the channel. I hope you guys are having a great day. Today we're talking about how much money do you actually need to jump into the market. Online broker. You have Robinhood, you have E-Trade, you have tgdmgmt, you have Charles Schwab that just cut their commission into zero, and so on. The list just continues on. There's a million different choices. You're just gonna have to look around, find the one that you actually like yourself, and go ahead. The huge difference that these online brokers have done compared to the traditional brokers, when you called your broker at the bank, he set up the trade and so on, is that you will do all this from home, which means they can cut their commissions or fees to very low or even to zero. The new trend is zero, which means you can trade stocks for absolutely free. And there is no minimum deposit. You can put on whatever money you want up front. You don't have to have a huge paycheck, nothing like this. You can start with $1, you can start with $50, you can start with 100 and so on. Whatever you are comfortable with starting up with, you can put into your account and you can start trading right away. And this brings me to my next point. You can start up and you can start investing and you can keep investing as much as you are comfortable with every month. If you're able to set aside $10, put aside $10. If you're a larger paycheck, you can put aside $50. Go ahead, put away $50 and start investing them. If you can even put in more, 100, 200, I don't know how much you can afford, but put in whatever you are comfortable affording. Do not invest any money that you can't afford losing. So if you need this money to rent or to buy food or whatever, do not put them in the market because there is a risk. The money can disappear, but there's also the huge upside that it might turn into more. So get going, set up a budget and figure out how much you want to put in, because you should be putting in money every month. This is a saving account with a huge potential. So put in whatever you can afford. Put it on a monthly. Put it in monthly and figure out what path you want to go with. The point here is not to start out huge. You don't have to put up your own investment firm or put in a trust or even buy a skyscraper. Just put in the little bit you have. Like we talked about in the last video, the snowball effect is key to all private financing. When you want to start up, you start small, you build up gradually your portfolio, and it will keep rolling until you one day preferably meet the goal of financial freedom, and that you can actually start living off the dividends that we're getting in this portfolio. So let's get into some details. Money burning in your pocket right now. So let's jump into the three main ways that you can get started in the market as a small investor. Alright, so the first option we have is index ETFs. An index ETF is an index exchange traded fund, which means that the fund is just weighted against a specific index. Take the S&P 500, the FTSE 100, the MSI Global, no matter which index it is, it's a copy 100% of that index. It's weighted to share that index, so if the index go up, so will the ETF. If the index go down, so will also the ETF. So this is a very simple way to buy a lot of shares. If you want to sleep good at night, if you want to be sure that your shares does whatever the market itself does, buy exchange traded funds. They will be highly diversified. And the point is, if you buy one share of an S&P 500 ETF, you will buy a tiny sliver of the holdings that share has in the whole broad S&P 500, which means you own a tiny part of all the companies in the S&P 500, but you have no right to vote or decide which one is actually going in and out. There is a fund manager somewhere else in the world taking these decisions on the behalf of all the investors in the ETF. So if you want to sleep well at night and you want as little as possible to do with the portfolio itself, buy ETFs. This will be professional managers doing this full time, knowing what the market goes up and down, and they will reflect this in the portfolio. So this is the perfect one if you want to spend as little time as possible reading all the reports that pop up at a company quarterly. You don't want to spend time doing this research yourself. Buy ETFs. A professional fund manager will look into it. You can pretty much sit back and watch somebody else do the job. Alright, so option number 2. There is great ways in the market to get exposure to hard assets as well. So if you're not interested in the ETFs, that is too much of a retirement plan. You want to buy hotels, shopping malls, buildings, things you can actually go look at and say, I own a share of that. Enter the Real Estate Investment Trust. These are companies that it's specialized in buying property. It's an investment vehicle that does nothing but own and manage a property portfolio. Alright, so let's look into what a real estate investment trust actually is. Real estate investment trusts are a vehicle of investment aimed obviously at real estate. Some of the great things here is that to be qualified as a real estate investment trust, it has to have at least 75% of the total value in real estate, in hard cold assets, buildings, hotels, shopping malls, real estate apartments, single family homes, whatever they specialize in. 75% of the total value has to be at all times in property. They can't be sitting in cash. They can't be speculating in stocks. Nothing of this. It's only property. Alright, so that's the first one. Second off, they have to pay at least 90% of their taxable incomes back to the investors every quarter, which means that they're gonna have a high dividend yield. So you can buy real estate investment trusts, sit on them for a long time, knowing that you are owning large buildings. Most of them invest in offices, hotels, shopping malls, public buildings, apartment buildings, docks, infrastructure, all these kind of things that is safe asset. They don't operate the stores, they don't manage the hotels, they just own the building, which means as long as somebody is inside the building, they will get paid. So this is a way, if you wanna put most of your money into buildings, knowing that as long as the building is standing, you will get your dividend pays as an investor. Real estate investment trust is for sure your thing to go about. So the biggest choice you're gonna have to do here is you wanna put all your money into real estate, then real estate investment trust is great. Then you can just have to figure out, you wanna buy hotels, or is it office buildings that you wanna invest in? Maybe it's multifamily homes, storage units, docking station, gas stations. All these kind of things you're gonna have to figure out, because there is real estate investment trust for everything. Alright, so I said I had 3 different ways that you could invest in the market. We've been through ETFs, we've been through real estate, so I guess you can figure out what the third one is. Of course, I'm talking about equities, stocks. Alright, so the last one, of course, that all of you have been waiting for, because you don't care about all the other ones, is stocks. You can buy stocks in individual companies and do the research yourself to make as much money as possible. There is no management fees, only the commissions if you do not use a web broker. But most of you people looking at this video will be looking to be independent financially. So I'm assuming that you're using a web broker with 0 commission. Because I mean, why else would you be here, right? We are doing this to make as much money as possible, so why on earth would we give away money for somebody to do something that we could do for free elsewhere? So stocks is the most common saving. You buy individual stocks that fits your portfolio, and you either watch them grow or you watch them dive. Hopefully you watch them grow more than dive, but this is also where it gets tricky, because by buying individual stocks you're gonna have to get the research done. You're gonna have to figure out, is this a good company? What is the risks in putting my money into this company? How big should my portfolio be? What kind of stocks should I buy? Why should I buy these stocks? Where should I locate my stocks? Should I buy American stocks? Should I buy European stocks? Should I put my stocks in Asia? Should I invest in the emerging markets? Should I gamble on China or Russia or Africa for that matter? Where should I put my money? This is where you're gonna have to figure out what kind of investor you wanna be. Because when you buy individual stocks, it's all down to you. You're gonna have to do the research. You're gonna have to figure out what kind of companies you want, how large of a portfolio you want, and what is important for you to look for in a company. Are you doing this for the dividend? Then you should definitely look at the US market that is paying quarterly dividends. You should look for the companies that have high dividend yields and stable cash flows. If you want to do this long term and you want to look for the next unicorn, maybe you should look for the emerging markets or even at the startup or private equity markets to find out what is going on, what is going to be the next trend, and so on. So the most important thing you're going to have to remember, when you buy stocks, you just don't buy a paper. You buy an actual owner share in a company. So you're going to have to find out what profile fits for you, what is important for you, what is your future plan. One of the benefits is that the dividend paid by the company is not going through any managers. It's going directly into your account. You can look at the money, you can take out the money, or you can reinvest the money. It's all up to you. There is no fees, there's no managers, there's nothing. The money goes into you. Second off, when you own the shares yourself, it's also your responsibility to go to annual meetings, read the quarterly reports, all of this stuff. Or you can have somebody else do the analysis and come up with the hotshot points to tell you like what they think about it. Alright, so let's take one step back and look at what we talked about in this video. First off, we had exchange traded funds. ETFs. That was the safest way that we invested in this market. It's a huge diversification, little risks, because you will follow the market in whatever way it goes, and all the work is put on professional managers. Second off, we had real estate investment trusts. This is hard assets. This is nothing but real estate. So it's safe assets as long as they don't go bankrupt, but you're also not diversified for anything else than real estate. Your whole portfolio is real estate and the dividend coming from real estate. And then third, we had shares, stocks, ownership in individual companies chosen by you, for you, with the investment principles that you hold. These are the most risky because it's all up to you, but it is also the one that can be the most beneficial in the long term. All right, so the three ways that we just discussed is the three easiest way that you can enter the market with any amount of cash. You can start with a $50, $100, 150, 1,000, 5,000, 100,000, whatever the money you have to spend. These are the three easiest way to get into the market and get a share of the pie. So I have a few basic books that I read myself, that I found valuable, and that should be easy to read at any level of investment knowledge. So I'm gonna put them down in the description below. That is my list of 5 books that I would recommend that anyone looking to get into the market, starting to get an understanding about how markets work, should read. So I know this might seem like a small thing for you guys, but it do help me out a lot, so please do smash that like button, subscribe to my channel, and check out the books in the description below. And with all that rambling said, all I have left to say is thank you guys for watching, I hope you enjoyed the video, and I'll see you again next time.
I was knocked down, heard the countdown through the haze in the face of defeat, yeah. I was ruled out with no bailout on my own, all alone, left to bleed out.